Welcome to Cyprus Tax Life. Today we're breaking down the 60-day rule, one of the most attractive features of the Cyprus tax system. It allows entrepreneurs and remote workers to become Cyprus tax residents with just 60 days of physical presence per year, instead of the standard 183 days required by most countries. But here's the thing. Spending 60 days in Cyprus alone is not enough. There are 5 specific conditions that must all be met simultaneously. Missing even one of them means the rule does not apply, and tax residency defaults to the standard 183-day test. So let's go through each one. Requirement number 1, spend at least 60 days in Cyprus during the calendar year. This is the most straightforward condition. The days don't need to be consecutive. You could spend January and February in Cyprus, that's roughly 59 days. Travel extensively for the spring and summer, and return for a few days in December to hit the 60-day threshold. An important detail on day counting: the day of arrival counts as a day of presence, and the day of departure also counts as a day of presence. So a trip from Monday to Friday counts as 5 days, not 4. Keep boarding passes, passport stamps, and flight records as evidence. Requirement number 2. Do not spend 183 or more days in any single other country. This is the condition that trips up most applicants. It's not enough to spend 60 days in Cyprus. You must also ensure you don't become tax resident in another country through their standard 183-day test. The practical implication: your time must be spread across multiple countries if you're not spending the majority of the year in Cyprus. For example, spending 100 days in Cyprus, 80 days in Spain, 70 days in Portugal, and the rest traveling, that works. Spending 60 days in Cyprus and 200 days in Germany, that doesn't work. Germany would claim you as a tax resident. Requirement number 3, maintain a permanent home in Cyprus. A permanent residential property must be available in Cyprus throughout the year. This can be owned or rented, but it must be a genuine residence, not a hotel room, not a short-term Airbnb. The rental contract should cover the full calendar year. Popular cities for a home base include Limassol for its international business community, Larnaca for affordability and convenience, and Paphos for quality of life. Requirement number 4, have business activities or employment in Cyprus. There must be a genuine business or employment connection to Cyprus. The most common arrangement is being a director or shareholder of a Cyprus limited company. Being employed by a Cyprus-based employer also qualifies, or operating as a self-employed sole trader registered in Cyprus. The important nuance here: the business must have real substance. A shell company with no operations, no clients, and no revenue would not satisfy this requirement if challenged by the tax department. Your company should have genuine business activity, issue invoices, maintain records, and file tax returns. Requirement number 5, not be tax resident in any other country. This ties back to requirement 2, but goes further. You must not be considered a tax resident of any other country during the same calendar year. This means you may need to formally deregister as a tax resident in your previous country of residence. Now, why does all this matter? Because when you combine the 60-day rule with non-dom status, you get one of the most powerful combinations in European tax law. You become a Cyprus tax resident by spending just 60 days per year in the country. You get full non-dom benefits, meaning zero special defense contribution on dividends, interest, and foreign rental income. And you maintain the freedom to travel and live elsewhere for most of the year. The only remaining cost on dividends is 2.65% for the healthcare system. Let me give you a real example. Imagine a remote entrepreneur. They spend January and February in Cyprus, that's 60 days, then March through May in various European cities, never more than 60 days in any one country. Summer in Southeast Asia. September and October back in Europe. November and December partly in Cyprus, partly traveling. They maintain a rented apartment in Larnaca, 12-month contract. They're a director of their Cyprus limited company, which has real clients, issues invoices, and files taxes. They have not spent 183 days anywhere else. They've filed the proper paperwork. Result: full Cyprus tax residency, full non-dom benefits, effective dividend tax rate of 2.65%. The 5 most common mistakes with the 60-day rule: not counting days carefully enough, accidentally spending too many days in one other country, using a short term rental instead of a proper 12-month lease, having a company with no real substance, and not formally ending tax residency in the previous country. For the full checklist with every requirement, real examples, and day counting templates, visit CyprusTaxLife.com. That wraps up Season 1 of Cyprus Tax Life. 5 episodes covering the fundamentals: non-dom status, the tax haven question, Cyprus versus Dubai, common tax mistakes, and the 60-day rule. If you found this useful, subscribe and tell a friend. We'll be back with more. Thanks for listening.